and it's important to get the order right here. So start off with your personal circumstances and determine your personal budget for the next 12 months. Then do your business budget and see if your personal budget is achievable given the business cash flow and profit forecasts. So let's have a look at those aspects in more detail. The first step of improving cash flow and reducing the stress and strain on your business at any time is to review your personal budget. What different spending habits have you adopted recently that have been imposed on us that perhaps you should carry on? Or what old habits and costs can you eliminate? Now, we've got a great personal budget template that we can share with you that helps with this. Goes through all the different sectors of your spending and evaluates it, and it's got even an actual to budget section in this as well. So once you've done your personal budget, then you'll update your business budget. Now, of course, that's a far more complicated exercise as it pulls together different scenarios that you're planning. For example, if you're going to introduce new products or services, you'll need to project as best you can what the predicted sales and costs will be, and the cash flows. Of course, cash flows are have different timing elements to it, and different scenarios can get relatively complex within the planning exercise when you're deciding which one to go for. Different marketing and communication decisions will also have an impact on business cash flow, as will your HR. So we're building all of those decisions in to your financial forecasts. Your business budget can then become more of an iterative process that will need constant review and updating. In normal circumstances, more stable circumstances, I advocate it's not necessary to review your cash flow and your budgets more than every 6 months or maybe a year, because in reality, as soon as you've set them, things change and you want to tweak them. But in times where things are less certain and there's more risk around, it is more important to review them, perhaps informally every month, but you should be doing that anyway when you compare your actual results to your budgeted results, so you can see what's going on, and maybe flex the cash flow going forward on a quarterly or 6 monthly basis. So by working with us, we can help factor in some of the more complex aspects like tax, government assistance, bank finance, and capital expenditure. All of these are important to get in the right place in the cash flow. And if you're doing it on a simple spreadsheet, that can be really very difficult to achieve, especially with different scenarios. And then we can also help you with managing your cash flow on a regular basis. Cash flow is the lifeblood of business. And if you've struggled with cash flow in your business, it will come down to just one or more of these. I've distilled it down into 7 causes of poor cash flow. And having a close look at these as part of your planning is essential to look at each one. The first is your accounts receivable or debtors process. So who do you give credit to? What payment options do you give them? And what do you do if they don't pay? If you could reduce the number of days your debtors take to pay you by 10 days on average, how much extra cash would that put into your bank? The second is your accounts payable or creditors process. What controls have you got in place on expenditure? Can you get a better deal with any of your suppliers to push out payment terms? Difficult at the moment, but you need to try. The next is your stock or production process. How much stock do you need to hold? Perversely, at the moment, stock is difficult to get. Perhaps your stock holding has got to increase, and just-in-time processes are actually being put on the back burner. What lines do you need to no longer supply to customers? What controls do you have to have on ordering? How can you streamline the production process? Next, having the right debt or capital structure. Having it wrong can really cripple your cash flow. For example, even though interest rates are generally low right now, if you've got an overdraft or credit card, can some of that be converted into a term loan? Reduce interest, and get it cleared over time? Should you sell other investments to repay debt in your business? What bank finance is out there? Are you making use of the current new round of bank funding that's out there backed by the government? Overheads. Overheads are costs which don't change based on your sales level, like utilities, rent, advertising. Those should all be reviewed at least annually, and at the moment, far more frequently. Can you switch utilities to a different company, get a better deal? Are your premises the right size? When can you move out? When do you need to expand? All those things can affect your cash flow. Your gross profit margin. We touched on that when we were looking at sales. What can you do to increase your margin? Is there pressure on your margin to push it down? How does that affect your profits coming through and your cash flow coming through? Can you rework how much you're wasting and time that you're wasting, improve productivity, improve the speed of things that go through your system? Look at prices, as we've spoken about before. Remember that table that we looked at shows the effect of increasing and decreasing, and I can share that with you again if you need. And finally, we've spoken about sales quite a bit. That's got to be a big consideration, and look at different ways you can change your sales or the way that your sales are going to be pushed by the marketplace. Now, this list is obviously, it can be overwhelming. There's a lot there, but again, like with the goals and like with marketing and other things, choose one or two of these strategies to implement, the one or two that can have the most significant impact. Work on them, get them done, and then reevaluate and do the next few. Small changes to these, small changes can have a really huge impact on your cash flow. Maybe not immediately, but going forward over several months or a year, and you'll really see the difference. 1 or 2%, small little tweaks. We can help you look at those most important ones and establish the most relevant ones to your business and share ideas for improvement overall. We've been talking about sales. I just want to touch on 7 ways that you could possibly grow your business. 5 relate to increasing sales, and 2 relate to reducing expenses. You might think that you're in a place to grow your business, or you're not in a place to grow your business right now, but these strategies are so important for getting back to business and recovering as much as possible, as well as growing from where you are. The first is to increase your customer retention rate. What can you do to delight your customers, to make them want to return to you again and again? Do you know what it is your customers really want? What is your current communication strategy with your customers? The second is to generate more leads, attract more prospective customers, reflect on what we've been talking about today. What can you do to get your brand and business in front of more of your ideal target customers? And the third is to increase those leads and convert those leads into customers. What can you do to increase your conversion rate or your proposal acceptance rate? You put in all that hard work, you've got a new customer, you put a proposal to them, and then are you falling down at the last hurdles? What's going on at each of those stages? Work out how you can improve on that. Next, increase the transaction value, or get your customers to spend more with you each time. What additional opportunities have you got to sell to your customers? Upselling, bundling, all different ways to increase that value of the transaction. The fifth way is to increase the frequency of transactions, or get your customers to buy from you more often. How can you encourage them to buy more often? The sixth way is to reduce your cost of sales or your variable costs. Now, can you get better supplier terms? Can you increase your efficiency or reduce your wastage rate? And finally, reduce your overheads or fixed costs, which we just looked at in one of the causes of poor cash flow.